welcome to another brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. This week, we are diving into the fast-growing universe of passive mutual funds. We will discuss the pros and the cons and the factors that you must bear in mind while deciding and selecting passive funds that may be proper for your portfolio, and will help you understand how an investor can get the best out of active and passive investing strategies, both combined in your portfolio. To help us do this, we have with us on the show two guests today. We have Pradeep Keswan of SBI Mutual Fund, and we also have Harshvardhan Roongta of Roongta Securities joining in. Gentlemen, thank you so much. And I'm quite excited about this subject because, you know, it is the brave new frontier in investing, as it's called, right? Maybe not so new anymore because passive funds have been around and they're growing. But we want to really start with the basics. It's a classroom 101, and get your thoughts in on the concept of being in funds where there is no active human fund manager taking the buy and sell decision. Now, Pradeep, opening thoughts.
Sure. So, as you rightly said, the very first difference between an active fund and a passive fund is that in an active fund, there is a fund manager taking active calls in terms of what to buy, when to buy, how much to buy. Whereas when it comes to passive funds, you don't take any of those decisions. You, in a way, quote unquote, outsource that part to an index creator who creates an index. And as a fund house, you just follow that index over a period of time. From an investor's perspective, what this means is a passive fund more or less will give you a return which is absolutely mimicking the index that it is tracking. Whereas the fundamental idea of an active fund is to outperform that index over a period of time. That's at the base of it.
Okay. Harsh, your opening thoughts. Like I said, I mean, we've done enough shows on this, right? Because passive funds really came on the horizon at least some 6-7 years ago, and they're only growing now. What do you make of things as they stand?
So, well, Surabhi, we must understand the Indian demographics also for that matter. Now, if you look at the developed markets, you'll see the passive funds have been in existence for a very long time. Yeah. And the largest assets are being managed by the passive funds. Now, in Indian markets, we had this information dissemination kind of the issue that was there. You still had pockets and you still had opportunities where you could have access to that information before somebody else did, and you could possibly gain some, generate some alpha because of it. So the Indian context, there was still a case to have active fund management, and that is how the markets were developing. Off lately, we'll see that, the information dissemination process has become very efficient. And it's very difficult for you to get a privileged information which the market does not get in before, So it's very difficult to do that. Now you will see this shift where investors will start again, focusing on the passive funds. Purely because, we've started getting the data points to see whether how many active funds have been able to beat passive. So as those numbers keep reducing over a period of time, I mean, we'll see investors shift focus towards the passive side. Also, there's another advantage is, of course, the cost side of the passive funds being lower on the cost side when compared to an active fund. And then when you study the report after, say, probably a period of 3 years, 5 years, 10 years, and if you believe and if you see that the passives are doing better in terms of returns, then why would you want to possibly look at an active fund? Or you'll have to have a combination of both. I'm not getting into whether active or passive.
That's a huge debate, right? The active versus passive debate. And for the benefit of viewers, let me tell you that, there are index providers. For instance, there is the S&P 500. So they come out with the SPIVA report, S&P 500, active versus passive. And many a times that report will tell you, how many large cap funds, for instance, are underperforming their, passive peers, so on and so forth. So it's a burning question in the industry, whether you're better off in a lower cost passive fund or whether you should still pay for the fund manager's mind, the advice and active stock selection. And that's what we'll debate and discuss as we go on. Now, for the benefit of viewers, just to talk about some of the categories, what kind of passive funds are out there? And you'll get to know more as we go forward. These could be index funds. We could be talking about exchange-traded funds. Fund of funds, basically a mutual fund that has a basket of funds under it. That could also be a type of passive product. And then there is something called smart beta, which requires a little bit of application of mind. Okay, so I think we know by now that it's not one versus the other. It's a question of having the right mix and the right blend to help us meet our investment objectives. So Harshan, that's where it gets complicated, right? Now, how do I decide whether if I want to do mid-cap investing, should it be through a passive fund or an active fund or a large cap? Should it always be a passive fund? Where do you begin?
So we put it like this, okay? So we'll divide the investors in different categories. So there is one set of investors who are well heeled into the stock markets. They know exactly, why the stock markets do what they do. Okay, so they understand government policies, they understand external factors, the systemic risk and all that bit. So for them, they're able to even identify fund managers whose investing style they match with. So some investors, some fund managers, for instance, will be more value oriented. Some will be growth oriented. Some will be momentum oriented. So there are different styles of investing. Now, these set of investors who are well heeled in the stock market themselves would possibly be able to identify an identical fund manager which matches with their requirements. So they are good enough to go and possibly try and get that extra alpha with the fund management skills. Now look at the other spectrum of investors who are new to stock market. They don't understand anything. The only thing that they have in their heart is that we want to invest into stock market. And we don't know anything beyond this. So they don't know what fund managers do. They don't know different kind of investment styles, etc. So for them, a good starting point would be that why not I just pick the entire market myself? Okay, so I'm not leaving any discretion to the fund manager to say that you pick, say if I take a large cap fund. So I could take a Nifty 50 or I could take a Nifty 100. So in this particular case, you will say that, okay, I'm taking Nifty 50. So all the 50 companies of the index are coming into my basket and I'm going to get returns that the market generates. So simply put it in that Ramayana kind of a story. Hanumanji was assigned a task to get Sanjeevani booty. Now he went onto that Parvat and he said, look, I don't know what's happening. Let's take the entire Parvat and walk off. Okay, so if you are that active fund manager, you know exactly what to pick on that mountain. And if you're a retail investor who doesn't know anything, don't want to trust with anything, you just then simply say, pick up the entire mountain and come. So there is a case, there is a buyer for every product. You just have to ensure that you don't do crisscross. So a retail investor coming into high beta fund and a knowledgeable investor going into a passive index fund may probably be a mismatch.
Okay, that's a great analogy, but Harsh, also sort of boil this down to a portfolio. I mean, so if I want to have a mix of active and passive, is there a ratio, proportion, and across market capitalization, what should I really look at? How to build a portfolio?
So, well, a retail investor, okay, and I won't talk about people who are well heeled into the market. Let's talk about a retail investor, which is generally the larger population of investing right now. Okay, so you divide your portfolio into core and satellite approach. The strategy is very simple. So the core portfolio consists, it will be a predominant allocation, which would say about 50% or so. Now that goes into large caps, that goes into quality companies, that goes into companies which are fairly valued and rightly valued, etc. The balance amount could go into mid caps, small caps, thematics, sectors. It could, it could be a tactical allocation with something that you believe the industry trends are going to change, the government policies are going to impact some, particular sector. So you may have a satellite approach, which is towards the other part of it, which could go into all those, areas such as I said, mid cap sectors, themes. It could be, anything to do with government policies, etc.
And you will use passives for the large cap side, because going back to what you said,
Correct.
that that is where maybe there's enough information already that's out there that has been discovered.
Correct. So then so this is the allocation side of it. Now when you come to fund selection. So in the core portfolio side, you will find that the passives are going to be a good strategy to allocate your money. So large caps, invariably we've seen that the large cap passive funds have kind of done better than an active side. Okay, so large cap in the core portfolio, you can allocate towards the passive side. Whereas when you come to the satellite, part of it, where we say that it is a lot dependent upon government policies, the market trends, it's got to do with a lot of things that we are trying to look at. So their individual's contribution is going to be high. So the fund manager could potentially be able to identify those sectors or those themes or those policies which are likely to...
So leave that to the fund manager. Pradeep, do you agree? Personally, for your investments, would you follow this approach?
No, absolutely. The core and satellite definitely makes sense. And I love the way Harsh has put it. In fact, core and satellite is also one of the philosophies of our own investing, even within active style. But I can totally relate that to a personal situation for an investor. So active versus passive is all about information arbitrage. It's all about how do you create alpha, right? If the ability to create alpha does not come in, then definitely makes sense to have passive. So to that extent, passives have a place. Whether we call it core, whether we put it in large cap, yeah, of course. That is a decision that the investors has to take in consultation with the advisors. But definitely, I would agree with his view on.
Okay, so understood, that's the core and satellite approach, but that's the easy part. Now we have to come to the more difficult part, which is something known as smart beta investing. So you might hear this phrase, smart beta or factor-based investing. This basically deals with multiple factors. These could be the concept of having momentum or alpha or low volatility, stocks that don't move around, jump around too much. And there is a method of investing based on one or more of these factors. So, gentlemen, you have to really simplify this for our viewers. Pradeep, you go first. What is this whole idea of smart beta and how does it tie in with the passive investing universe?
Sure. So first up, our house view, right? So we don't consider smart betas as passive products.
Okay.
So you should look at investment products as a spectrum. At the one end of the spectrum is pure active funds, where active fund managers take active calls. On the other end of the spectrum, we have index-hugging passive funds, where there is no decision to be made, you just follow the index. Now, in between these two ends of the spectrum, you can create n number of combinations where there can be a light touch smart beta. The smartness, of course, comes from the product house which creates the smartness, which will determine where within the spectrum you do. It will not be as active as the active fund. Therefore, it will not be as expensive as the active fund. It will not be as passive as the passive fund. Therefore, it will not be as index hugging as the passive fund also. To give an example, within SBI Mutual Funds bouquet, we have a fund called Minimum Variance Fund. So what that fund does, for example, we work within the universe of Nifty 50 companies, but within Nifty 50, we have an algorithm which looks to minimize the variance or minimize the volatility that happens among the stocks. And we look for low volatility stocks in that universe. And the aim is to, over a period of time, beat the index again. As against passive funds, we will try and beat the index at a very minimal cost. That's the idea of smart beta strategies.
Okay, fair enough. So for you as a fund house, I mean, these are basically, it's like rule-based investing. It's based on an index, but within that, you're using certain other parameters, creating a rule, and then going by stock selection as per that rule. Got it. Harsh, come in on this because there are other products, smart beta, where there is actually an underlying index. I went on the NSE website. I mean, there are like, I don't know, so many indices, 20, 30 indices called NSE 200, low volatility, alpha, momentum, this, that, whatnot. So it can get really daunting. But the reason we need to start understanding this is that there are so many new products being launched on these, smart passive indices.
Yeah, so, it's good for the investor. Let me put it like that. Okay, so Pradeep rightly mentioned, if you have a scale, on one end, you have the active funds. On the other hand, you have the passive funds. Now, there has been a debate ongoing, what is better, what is not, right? Now, what about a situation? Okay, like, let me give you an example, Nifty 100. So there's a Nifty 100 index fund. What it does is it invests into all the 100 companies in the Nifty 100.
Yeah.
Now, if there's an investor, now within these 100 companies, there would be some companies which are highly volatile currently. There could be some which are very expensive in their valuations.
True.
There could be something which is moving in momentum, etc.
Yeah.
Now, I as an investor say that, look, I want to invest in this top 100 only. But I'm a conservative investor. So I don't want a high momentum stock. I don't want that into my portfolio.
I want low volatility.
I want low volatility. I am a conservative investor. So what I do in this case, I go for a Nifty 100, low volatility 30 index fund.
Okay.
So my profile says that I believe the markets are expensive, but nobody has the courage to be out of the market right now. So, I can't just simply walk off the market, sell off everything and walk off. So I want to be invested in the market. But my sense is the valuations are expensive. So why not I go for something which is, in terms of value. So I pick a index fund, a smart beta index fund, which invests into value-oriented companies. So my selection in that index will be, the valuation will be matrix. I want to go for something which is not as volatile. I go for a low vol. I am bullish. I say that, look, I'm very, very aggressive on the market. I don't want a passive index fund and to sit on it. So I go for a momentum factor-based investing in that index. So basically, an investor has now got a choice that he chooses something which is on the passive side, but he picks, the factor which suits that investor profile and picks a scheme exactly which matches that profile and gains from that strategy.
So this tells me one very important thing. I mean, two very important things, actually. That one, yes, there is more choice for the investor. So that's the good news, like you said. But secondly, we need to understand these factors and our own objectives and whether, I am a low-risk person, so I need low volatility. We need to know ourselves a little better. So, Pradeep, what is the advice you would give to investors who might want to experiment with some of these newer, fancier products in the market? What are the do's and don'ts here?
Yeah, definitely. There are definite do's and don'ts here. First is when somebody looks at passive for the first time, try and look at a bigger index, which is well tracked, which has got depth in the market, right? It's easier to get into narrower indices, but with time, you will find it difficult to kind of match the index in terms of performance. So that is the first thing that a beginner sort of an investor looking at passive should do. Second thing is they should also understand and try not to get into single factors or try not to understand factor timing, so to speak. Factor timing is like market timing. When which factor will do is very difficult to understand, and there is an army of people who are sitting and trying to understand that and still failing. So a better thing to do, it's almost like you think of it from a diversified mutual fund versus a not so diversified thematic fund, right? There is a space for both. But as an investor, you should know where to put what, right? What portion of your portfolio should be diversified and what portion of your portfolio should be into thematics. A similar concept applies when it comes to passives also, when it comes to factor investing also. So first place to start will be to look at multi-factor models where multiplicity of factors come into play at the same time. Therefore, there is some amount for the quantitative model to play around and juggle around with the factors that might work in a particular market condition, rather than putting all your eggs on a single factor and hoping that works for a long time.
All right, so I think those are some basic rules that one can keep in mind while you're looking at some of these absolutely newer products. And some of them, by the way, are giving fantastic returns because, let's say, right now the market is in momentum. So some of the funds that are based on the underlying factor of momentum, they typically will give you a good return. But the things you should keep in mind when you evaluate your choices. We need to take a break on that note. We'll come back on the other side. Now, investing in different themes is a very big sort of sensation in the market right now. How should you do this? Active or passive? The debate continues on the other side.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are on the active and passive debate. Remember, if you pay attention, I didn't use active versus passive because it's no longer about one over the other. It's about the right blend in our portfolios. So our guests are with us. Now, the next question that we've been getting is how to invest in themes. And themes are very, very big. You gentlemen know, right? So infrastructure, PSU, defense, and typically investor psyches, when we see these stock prices surging, one gets a bit of FOMO. Right. And one wonders whether you should invest in the long term in these themes. So Pradeep, first of all, what do you say to the feeling of FOMO? And then if one should invest, then what's the right route?
See, FOMO is something that is from the behavioral side of investing. Interestingly, it is coming up when we are discussing a passive, which is more quantitative and number-based. Yeah. But having said that, right, so whenever people think about thematics, the only thing that I keep saying is please look at how broad is the theme, right? So one mistake that investors can easily make is drive themselves into very narrow themes, which are very cyclical in nature. And when the cycle turns, market returns can be bad for a long period of time. So that is something that some people have to be aware of when you look at thematic investing, whether active or passive. So that is something that people should be aware of at all times.
Okay. And so now if we're getting products, and we are, right? We are getting products. There could be a defense passive fund, which is basically hugging the underlying index, or an infrastructure fund. Are the risks greater if you are going into a passive thematic fund versus one that's managed by an active fund manager? Yeah,
risk is also very well measured. In fact, SEBI has got a wonderful way of showing it in terms of riskometer, etc. You will notice that typically thematic funds are considered higher risk in terms of their risk profile compared to diversified funds, and there's no escaping that, right? The reason why somebody would want to play a theme is if that theme is their high conviction sort of a theme which will outperform a broader diversified fund or market over a period of time. So that's the whole idea of getting into a theme. And having said that, it should also be part of like going back to Harsh's point on core versus satellite. You should think about how much % of my portfolio can be in these kind of thematics, and that percentage cannot be very high. That much is clear.
Fair. So actually, on that, Harsh, let me come over to you. You said core and satellite. So in satellite, some thematic funds perhaps that still merit a place. Which are the themes? What kind of funds would you allocate money to right now?
So, I'll just talk about certain smart beta funds that an investor could possibly consider. It need not necessarily mean that they're thematic in nature. So I'll name a few. So one is a Nifty 50 equal weight index fund. I'll go a little more into the numbers of this so that also we'll get to understand what is the reason behind that. Then you have a Nifty mid-cap 150 momentum 50 index fund. So what it does is it takes the universe of the mid-cap 150 stocks and picks up the momentum 50 companies that you can possibly invest into. The Nifty 500 value 50 index fund. So this is for a conservative investor that I was referring to, that they want to invest into the market, but want something which is fairly valued. So they look at the valuation basis And the stock selection of the 50 companies will be based on the valuation matrix. Then you have a Nifty Small Cap 250 Momentum Quality Index Fund, so which has 100. I'll repeat it because I see the expression.
It's a mouthful, yeah.
The expression
Nifty 100?
No, Nifty Small Cap 250.
Small Cap 250.
Momentum.
Within that momentum.
Quality.
100
index fund.
100 index
So what
fund.
it does is, in the universe of 250 small cap companies, it'll pick 100 companies filtered on the matrix of momentum and quality.
Got it.
So in my view, if you're a small cap investor, you don't really want all the 250 companies in your portfolio. Why are you investing in small cap? One, because there is momentum in those companies. Secondly, you want to ensure that you're buying into quality companies. You just want to pick everything that is in that space. So this smart beta fund helps you do that. So it is a Nifty small cap 250, momentum quality 100.
Wow, that's an interesting one. So now the rationale is clear that I think investors can go back, do their own homework, and see if these filters work for you, and then choose the products which could be appropriate. We have a question coming in, and let's take that as we start wrapping up. This is a question coming in from Sam. He's writing it on Instagram, and he's saying that are passive funds more cost effective, and if they are, then will this impact the CAGR return on the investment over a long period of time? So are they basically more efficient and better to be in? I think we've come back to the starting point, Pradeep, on this. So summarize for us the thoughts, because cost is a very important parameter, especially for someone who's not looking to trade in and out. You're looking to ride that fund for the next 5-6 years.
Right.
So then what are the things to consider?
See, cost is a consideration for sure. When we talk about cost, active versus passive, typically there is a 100 basis point, about 1 percentage point cost difference between these two funds. Now, the viewer has asked the right question. This 1 percentage point looks very small, but if you accumulate it over a period of time, it tantamounts to a lot of money. I'll give you a data point. We did an interesting exercise recently. From 1981, Sensex, since the time it came into being, 1981 onwards till today, if somebody had invested 100 rupees in Sensex in 81, and then the value of that today, it compounded by something like 15.2% CAGR. And in terms of multiples, it is like 456 times, which means 100 rupee put in 1981 is worth 45,600 rupees as we stand today. Now, we did another analysis. What if one fund had delivered 2% alpha over and above Sensex return? Instead of 15.2, it becomes 17.2. This number of 456 becomes 1,000 times. 100 rupees, instead of becoming 45,000 rupees, becomes 100,000 rupees, 1 lakh rupees. That's the sort of difference a 2% can make over 25, 30 years. Now, obviously, I'm subtly pitching for active management here, but the same thing in inverse can also work in terms of cost. When you accumulate costs over a long period of time, they also kind of add up to a lot. And that's why the attractiveness of passives come into picture whenever there is no alpha to be found.
Okay, so go for passive if there's not enough alpha, if the fund is not beating the benchmark or its peer set substantially. I guess that's an important takeaway. All right, gentlemen, thank you so much for joining in. That was a very, very helpful conversation. Lots of food for thought. And I think investors can go back, do their homework, and then decide what is the right blend of both active and passive strategies in our portfolio. That's a wrap on this week's edition of Let's Talk Money. Keep sending us your feedback, your comments and queries. We'll see you again on the show next week.
Let's Talk Money